All right, so today, let's take a deep dive into a couple ETFs.
Okay.
You shared that Motley Fool article about two that they recommend holding, for like your whole life.
Right.
So we're really talking about long-term growth and simplifying investments, which is always a good thing.
Definitely. Yeah.
And the two ETFs that they highlighted were VUG and SCHD.
Yep.
And they offer kind of some interesting contrasting approaches.
Yeah, for sure.
So let's start with VUG.
Okay.
The Vanguard Growth ETF. And the article mentions its 20-year track record and a SCHD of 11.7%.
Yeah.
That's outperforming the S&P 500.
It is.
Which is pretty impressive.
Pretty significant, yeah.
What do you think contributed to that kind of performance?
Well, if you look at the holdings of VUG, you see it's very heavily weighted towards, those big tech names, the Magnificent Seven,
right?
Apple, Nvidia, Microsoft, Amazon. They've been driving a lot of the market growth that we've seen, in recent years.
Yeah, makes sense.
Yeah.
So it's kind of like riding the wave of, tech innovation.
Yeah.
But is that concentration in tech a potential risk too?
It's a valid concern.
What if that sector slows down?
Well, any ETF that is, focused in a specific sector is going to be more vulnerable to fluctuations in, that sector's performance.
Okay.
So it is a trade-off for the potential high growth.
So high growth potential, but also higher risk.
Yeah.
Let's unpack that a bit more.
Sure.
What kind of risks are we talking about with VUG specifically?
Well, I think with VUG, a major risk is its reliance on the continued success of, these tech giants. While they've been on a roll, their dominance is not guaranteed.
Right.
Competition changing consumer preferences, even new technologies emerging.
Yeah.
Any of those things could impact, their growth trajectory.
So even though past performance is strong, it's not a guarantee for the future.
Yep.
Got it.
Yeah.
The article also mentions VUG's low expense ratio.
Yes.
Only 0.04%. Can you explain what that means for someone who's just getting started with ETFs?
Sure. The expense ratio is essentially the fee that you pay to the ETF provider for managing the fund.
Got it.
It's a percentage of your investment.
Okay.
So in VUG's case, for every $1,000 you invest, you're only paying $0.40 in fees per year.
That seems pretty reasonable.
It is. Yeah, it's very low.
So low fees and strong historical performance.
Right.
But with the caveat that it's tied to the future of the tech sector.
Right.
Now let's switch gears and talk about SCHD.
Okay.
So SCHD, the Schwab U.S. Dividend Equity ETF, is a different beast altogether.
It is.
It's more focused on generating income through dividends rather than chasing those high-growth stocks.
Yeah, it's not a pure growth play.
Okay, so for someone who's looking for a steadier stream of income, this might be more appealing.
Exactly.
Tell me more about its holdings.
Sure.
What kind of companies are we looking at here?
So you're going to think of like more established, well-known companies with a history of paying consistent dividends.
So.
Companies like Chevron, Altria Group, Verizon.
Got it.
The kind of companies that have weathered different economic cycles and continue to reward their shareholders.
So it's a bit more of a slow and steady wins the race approach?
Yeah, I think that's a great way to put it.
Okay.
And that's reflected in its performance. It hasn't seen the same explosive growth as VUG.
Right.
But it has provided that reliable stream of income through its dividends.
Okay.
And it still has a very low expense ratio, 0.06%.
Yeah.
Which is, attractive for long-term investors.
Interesting. You mentioned it hasn't grown as quickly as VUG.
Right.
Can you put some numbers to that?
Yeah.
How does its performance compare?
So over the past decade, SCHD has achieved a CAGR of 11.7%.
Okay.
Not bad at all.
Yeah.
But the S&P 500 clocked in at 13.2%
Wow.
over the same period. So that means a $1,000 investment in the S&P 500 10 years ago would be worth about $500 more today than the same investment in SCHD.
So there's a potential opportunity cost there.
There is, yeah.
Right? You might be missing out on some market gains by prioritizing dividends.
That's true. It's a trade-off. Investors need to consider the steady income from dividends versus the potential for higher growth elsewhere.
And that brings us to the heart of it, doesn't it? Which one is the right choice?
Well, that's the million-dollar question, isn't it?
Yeah.
But honestly, there's no one-size-fits-all answer.
It really depends on individual goals and risk tolerance.
Absolutely. And that's something we're going to explore further as we dig deeper into these ETFs.
Okay, so stay tuned. We're just getting started.
Yeah.
So we've talked about performance and risk.
Right.
Let's shift gears and talk about the types of companies each ETF actually holds.
Okay.
The Motley Fool article breaks down their top holdings.
Yeah.
And I'm curious, what jumps out at you when you look at those lists?
It's really interesting how clearly the holdings reflect the ETF's overall strategies.
Huh.
VUG's list reads like a who's who of tech innovation. Apple, Microsoft, NVIDIA, Amazon.
Yeah.
All about, disrupting industries, pushing the boundaries of what's possible.
And SCHD, on the other hand, feels much more grounded.
Exactly. Yeah, you've got those steady, reliable names like Chevron, Altria, Verizon.
Yeah.
These are companies that have been around for decades,
Oh.
and they're not going anywhere anytime soon.
Yeah. It's almost like two different philosophies of investing.
Yeah.
VUG is betting on the future, while SCHD is more anchored in the present.
That's a great way to put it.
Yeah.
And I think that distinction really highlights why understanding your own investment goals is so crucial.
Right.
Are you looking for, those potentially explosive returns, even if it comes with higher risk? Or are you prioritizing stability and a consistent stream of income?
Right. There's no right or wrong answer.
Exactly.
It all comes down to individual needs and preferences.
Yeah.
But even with those differences in philosophy, both VUG and SCHD have those remarkably low expense ratios we talked about.
Right.
Why is that such an important factor, especially for long-term investors?
Well, those seemingly small fees can really add up over time. Think of it this way. Every dollar you pay in fees is a dollar that's not working for you.
Right.
It's not growing your investments.
Yeah.
So minimizing those fees can have a significant impact on your returns over the long haul.
It's like the saying, death by 1,000 cuts.
Yeah.
But for your portfolio.
Exactly.
Okay, so we've got performance, risk, expense ratios.
Yep.
What else should we be thinking about when evaluating these ETFs?
I think it's really crucial to consider the concept of diversification.
Okay.
We've been focusing on VUG and SCHD individually.
Yeah.
But how do they fit into a broader portfolio?
That's a great point.
Yeah.
So someone interested in both wouldn't necessarily have to choose one over the other.
Not at all. They could potentially hold both as part of a diversified portfolio.
Okay.
Or they could explore other ETFs that provide exposure to different sectors, asset classes, or investment styles.
Right.
The key is to understand the role each investment plays in your overall strategy.
Yeah, it's about spreading your bets and not putting all your eggs in one basket.
Exactly.
So diversification is key.
Right.
But let's get back to this idea of holding these ETFs for a lifetime, as the Motley Fool article suggested. What are your thoughts on that approach?
It's a compelling idea, especially given their low expense ratios and the potential for long-term growth.
Yep.
But I wouldn't advocate a completely hands-off approach.
Okay.
Even with a long-term outlook, it's crucial to periodically review your portfolio, reassess your goals, and consider any needed adjustments.
So it's not a set it and forget it kind of thing?
Definitely not.
Okay.
Markets change, your personal circumstances change.
Yeah.
And your investment strategy needs to adapt accordingly.
So it's about finding that balance between a long-term mindset and staying flexible.
Precisely. And sometimes seeking guidance from a financial advisor can be helpful.
Wow.
They can help you navigate those decisions and ensure your portfolio stays aligned with your evolving goals.
Okay, so we've talked about performance, risk-expense ratios, diversification, and the importance of staying adaptable. What else should we consider?
I think it's important to touch on the elephant in the room.
Okay.
Politics.
Oh, yeah.
It's become such a pervasive factor in so many aspects of our lives, and investing is no exception.
I'm sure some of our listeners are wondering if VUG and SCHD have any political leanings, or if their holdings reflect a particular ideology.
It's true that some investors actively seek out investments that align with their political values. However, it's important to remember that both VUG and SCHD are broad-based ETFs that track specific indexes. And their holdings are determined by those underlying indexes, not by any political agenda.
So they're not choosing companies based on their political stances or campaign contributions.
Their primary goal is to track the performance of their respective indexes.
Okay.
Now, that doesn't mean that politics is completely irrelevant. Government policies, regulations, even the overall political climate can have an indirect impact on company performance and by extension on the ETFs that hold them.
I see what you mean. Like changes in environmental regulations could affect energy companies.
Exactly.
Which could then impact SCHD's returns.
Exactly. Or trade wars and tariffs could disrupt global supply chains and potentially affect the performance of tech companies held in VUG.
Right.
Politics can create both opportunities and risks in the market.
Yeah.
And it's something investors should be mindful of even when dealing with broadly diversified ETFs.
So while these specific ETFs aren't driven by political agendas,
right,
it's wise to stay informed about how political trends and events might impact the market as a whole.
Absolutely. Investing is not just about numbers and charts.
Right.
It's about understanding the world around us and how it impacts the financial landscape.
Well said. Okay, so we've covered a lot of ground.
We have.
Performance risk fees, diversification, and even the potential influence of politics.
Yep.
What's the one key takeaway you want our listeners to walk away with?
I'd say the most important thing is to understand that there's no one-size-fits-all answer when it comes to investing.
Right.
VUG and SCHD are just two options among many, and neither is inherently better than the other.
Okay.
The key is to choose investments that align with your individual goals, risk tolerance, and overall financial plan.
And that brings us to our final thoughts for our listeners.
Yeah.
We've really dug deep into VUG and SCHD, you know, their strengths, their weaknesses, everything in between.
Yeah.
And it's clear that, you know, they both have the potential to play a role in a long-term investment strategy.
For sure.
But I think the biggest takeaway for me is that investing isn't about finding the one magic ETF.
Absolutely. It's about understanding your own needs.
Right.
Your risk tolerance, and crafting a plan that reflects those things.
Yeah.
VUG and SCHD are just two pieces in a much larger puzzle.
And that puzzle is your overall financial well-being.
Exactly.
Right. It's about looking beyond just returns and considering how those investments fit into your life, your goals, your future.
For sure. Are you saving for retirement?
Yeah.
A down payment on a house, your kids' college education?
Right.
Those goals will shape your investment choices, maybe even more so than the specific ETFs themselves.
So it's almost like working backwards.
Yeah.
Figure out your goals first.
Right.
And then let those goals guide your investment decisions.
I think that's a great way to think about it.
Yeah.
And remember, those goals might change over time.
Right.
So it's important to stay flexible and reassess your strategy as needed.
Which brings us back to that idea of staying informed and adaptable. It's not enough to just pick a couple ETFs and forget about them.
Right.
You need to stay engaged with the market, with your investments.
Right.
And with how those things are impacting your progress towards your goals.
You hit the nail on the head.
Yeah.
Information is power, especially in the world of investing.
Yeah.
Don't be afraid to ask questions, to do your own research, and to seek guidance from trusted financial professionals.
So to our listeners, I hope this deep dive has given you a solid foundation for understanding VUG and SCHD.
Yeah, I hope so.
But more importantly, I hope it sparked a curiosity to learn even more, to dive deeper into your own financial journey.
Right.
And to build an investment strategy that's uniquely yours.
Remember, there's no one right answer when it comes to investing.
Right.
It's all about finding what works best for you.
And until next time, keep diving deep.